name is Saanvi Gullapalli.
And this is Deetya Parvatham. Today we will be talking about the 4 investment rules. Saanvi?
So there's 4 investment rules. The first one's investing early, the second one's diversifying your portfolio, the third one's investing for the long term, and the fourth one is understanding what you're investing in. So I'll be talking about the first one, investing early. The earlier you start investing, the more time your money has to grow. This is known as the power of compound interest. Essentially, your investments grow on your principal amount as well as the returns you've accumulated so far. I'll give you an example. So for example, if you invest $100 every month, starting when you were 10 years old till you were 40, that gives you 30 years of compound interest. But let's say you started when you were 20. Then you lose 10 years of compound interest. Time and compound interest are your best allies. Even if you invest a smaller amount earlier, then over time it can turn into a significantly larger amount. Deetya?
The second investment rule is diversifying your portfolio. Diversification is spreading your investments across multiple assets such as stocks, bonds, real estate, and other assets. The idea of this is that if one investment were to perform poorly, another may perform better, overall balancing and reducing the risk and chance of significant loss. Some stocks you can invest in are energy stocks, tech stocks, industrial stocks, etc., in both small or large companies. Some bonds you can invest in are government bonds and corporate bonds, etc. Some real estate you can invest in is residential, commercial, and international properties, and some other assets you can invest in are precious metals, commodities, etc. For example, let's say you were only to invest in one company's stock, for example, a tech stock. If this company were to face trouble, such as a product recall, then your entire portfolio may struggle. Instead, if you diversify your portfolio and invest in multiple different stocks, bonds, real estate, and other assets, then the chance of significant loss could reduce. Saanvi?
Yes, I'll be over the third rule, investing for the long term. A long-term mindset helps smooth out short-term market volatility. In the shorter term, stocks and assets may experience fluctuations, but in the long term, they tend to steadily rise. Markets go up or down in market corrections, recessions, or etc. But over time, there's a higher chance of experiencing profit. For example, if you invest in the S&P 500 in the 1980s, you would have experienced several market crashes in 2000 and 2008. But if you stayed invested, you would have experienced impressive growth, about historically 7 to 10%. Deetya?
The last rule of investment is understanding what you're investing in. Before investing in anything, it's essential that you understand what you're investing in. This knowledge can help you make informed decisions, reduces the likelihood of risk and loss, and it enables you to weather downturns more confidently. You don't have to be an expert, but you should at least have a solid understanding. If you were to invest in a company stock, you should understand the company, how it works, its business model, and its competitive advantage. If you were to invest in a bond, you should understand what causes prices to fluctuate and the risk. For example, if you didn't understand how a stock or bond worked, then the chances of loss are much more higher. Instead, if you understand what you are investing in, then you can make safer decisions and reduce the risk of getting caught in scams or risky investments. Saanvi?
All of these rules are really important. Starting early gives you an advantage to use compound interest. Diversifying your portfolio helps you reduce risk. Investing for the long term helps you ride through markets' ups and downs. And lastly, understanding what you're investing in helps you make informed decisions. Together, these rules make a strong foundation on building your wealth. That's it for today.
Thank you for watching.
Bye.